Hi, everyone. Hope you're out there. Brian and I kind of wanted to get together to talk about the current market conditions. I've been doing a lot of reviews. You've been doing a lot of reviews,
Yeah, we
and
have.
I would say that the market has been a little interesting,
We'll call it top of mind.
top of mind. Yeah,
People are thinking about it a little bit right now,
yeah.
maybe a little bit more than normal.
And it kind of we decided that we wanted to put together a little bit of a 20 minutes to 30 minutes talking about the market, so people understood what's happening, why we're seeing so much volatility,
Mhm.
and then maybe some strategies.
Of how to react or not react to it.
Yeah, and as well as what you do,
Coping strategies.
coping strategies, and maybe also some opportunities.
Yeah.
Okay. So that being said, I want to start out with the slide that we showed when we talked about the market um, in
The end of January.
the end of January. We're talking about the outlook. Does anybody, yeah, go ahead. Remember the picture we showed? It was a roller coaster, right? And we showed these two elderly people kind of like going on the road. They were smiling, right?
Right. We said they're happy on that roller coaster.
They were happy because they didn't get on the other side of the ride. The other side of the roller coaster, you're going to see them upside down with their feet up in the air, a little bit freaked out. Um, well, that's kind of what the past week has been.
Yeah. So Tim calls me today, says, "Hey, remember the roller coaster slide? I want it to say there are roller coasters and roller coasters."
Yeah.
So here you go. There are roller coasters and roller coasters.
And the past week has been quite the roller coaster.
Yeah, to say the least.
So if you remember when we talked about the beginning of the year, we talked about what we expect in the market. We expected that because of the current administration, which we call the disruptor administration, that we would see a lot of disruption. Okay. The current administration wants to change the way we do things in the United States. Whether you agree, don't agree, I don't care. It doesn't matter to me. It's the administration that we currently have. So the administration came out, and it's been telling us they were going to do tariffs. And initially, I think about a week ago, a week and a half ago, they came out with a 10%,
10% across the board. Yeah.
that was going to be 10% across the board, and then it decided to go to every country and add more.
Right. Various amounts, various countries.
Approximately about 50% of what the country was charging the United States when we send goods to their country. So when they did that, and I want to talk about what a tariff is because I think that's kind of important to understand. A
Do you
tariff is
want me to go to the next slide?
yeah, go to the next slide. A tariff is a tax, right? It's pretty much a tax imposed by a government on to import or export goods. So if the United States is going to send goods to another country, that country was charging us a tax to allow our goods to go there. And that country was also telling the United States what they were willing to take and what they weren't. Doesn't really sound like free trade, but it's trade.
Trade
And
nonetheless, right.
the United States, when other countries would send us goods, we weren't charging anything.
Or less because we had the lower tariffs in.
Well,
We had the previous tariffs that did not get.
Yes, we had some very small tariffs. So the administration felt that they wanted to get more bang for the buck because with what's going on in our world, the United States, we have $34 trillion in debt, which is a lot of debt. And the government doesn't manufacture anything. So the only way they can get money is by bringing money in through tax dollars, taxes from you and me. And they wanted to increase the tax slash the tariff from the other countries. So they put together this tariff, and the market decides that it would like to give an opinion on this. And quite the opinion it gave.
Oh, yeah. It gave it very quickly and
Very
decisively.
quickly. Yeah. So the market decided to send a message to the administration saying, we don't like this. And the market went down. I think the first day it went down about 1,400 points.
Right.
And then, that didn't seem to move the administration at all. And then the next day it went down almost 2,000 points. And I say this in the nicest possible way, but the president went golfing. He basically said
It's Friday afternoon.
It's
or Thursday afternoon.
We kind of have to. He said you're gonna have to take a little pain. So business as usual. And what we saw on Monday was there was a little bit of a rumor stating that the tariffs were going to be postponed, and the market within 10 seconds
bounced.
Went up like
off a springboard. 1,500 points in the course of about 4 minutes, maybe 3.
And then it came back saying that, nope, sorry, rumor, not going to happen.
Yep.
And then the
Even
market fell
jabbers.
again.
Yep.
So why am I telling you the story that you probably saw on the news? The reason I'm telling you is because there are rational markets and irrational markets. What we saw Thursday, Friday, Monday, whether up, down, and I would argue even today, is irrationality. Nothing has happened in the economy yet, meaning that
Yes and no, right? So we just have a little bit more today, anyway. We have a little bit more readability into what to anticipate for the next 3 months.
yes, we have readability in the respect that we know that the market does not want tariffs
Right? We
and
know
that,
the government knows. We know the administration knows.
but I'm
That,
not sure that means the administration is not going to do it. I think the administration, and again, the administration had other countries and companies come in and said, let's negotiate.
right.
And I think, and who knows,
Or time's going to tell.
but time's going to tell. But the next 90 days, I think
10% across the
negotiation,
board with the exception
10%
of China.
China,
Right.
and there's going to be, negotiations going across.
Mm-hmm.
But I think the important thing to know about this is that volatility is going to follow this administration,
Mm-hmm.
whether it be on tariffs, whether it be on Doge, whether it be on Social Security, whether it be on Medicaid. I don't care what it is.
Yep.
Volatility is going to follow this administration because this is not a typical administration. And I would argue in my lifetime, I've never seen an administration like this. So therefore, whether you like it or you don't like it doesn't make a difference. You just have to learn to live with it because that is what we have right now.
Mm-hmm.
So from a strategy standpoint, one of the conversations I've been having, and I started having before the year,
Right.
was about asset allocation, right? How much risk do you have in your portfolio?
Yeah.
And
we talked about it in our January meeting about the roller coaster.
Exactly.
That was the whole concept.
How much of the roller coaster can you handle? And I think that what's happened in the past 5 to 6 days is another time for you to reflect on how did you handle.
How did you sleep at night?
Right. How did you sleep? And maybe with the market recovering, because it's almost even. I mean, it's pretty close actually. I was looking at some numbers today on based on within hundreds of points. It's do you want to rebalance your portfolio? Because one of the things you can do when markets go volatile is there are opportunities with that.
Mm-hmm.
Opportunities to buy the dips. And I know if we watch CNBC, you got people out saying, "Got to be crazy to buy the dip." I don't think they would think that today.
No.
So I think that one of the opportunities, if you have money on the sidelines, bonds, cash, opportunities to take advantage of these dips and maybe profit from them. But again,
you gotta be ready to buckle up.
Yeah.
You gotta be willing to take the ride, understand. I just finished my 5 o'clock meeting was talking about, they're talking about investing some money, talking about how they're going to handle the volatility. And these are younger investors with a longer timeline. He's like, Brian, this is 10, 20-year money. I said, for 10, 20-year money, as long as you can sleep every night and never have a knee-jerk reaction when it moves 15% in the course of a week like it did this week, it's an opportunity. That's what we have in front of us.
And even really with our retirees, we normally have money that we draw from now, but then we have some growth money.
Right, our various pots of money. You've all heard us talk about your pots of money,
which are really more for long term.
Right.
So maybe in different strategies, but again, if you're all in, and some of you are because that's the way we've wanted to run your portfolio, right. That's what you've asked. Then you're just gonna have to sit through it. Right. You made the decision to be all in. If you want a more diverse portfolio where you have cash, bonds, and more of a mix, then you really need to come to us because in a volatile market, we are in a situation where we work within the portfolios that we have.
And with the risk profile.
Yes, with the risk profile.
We cannot and we do not change your risk profiles without talking to you. A change in risk profile is a change. We manage within the risk profile. We manage within the risk tolerance, and that's how we manage the portfolios. I'm going to go backwards for a second because there is a way a person who's all in could still gain some exposure to an opportunity if they wanted to buy the dip. And that's if we've got them balanced between dividend equities and growth equities, you would reduce what has gone down less and increase what has gone down more.
But you're adding
again,
a lot more risk.
Gotta have the stomach. Exactly. That's a lot more risk. That's going from moderate to aggressive to aggressive.
Yeah.
Right. I mean, it's saying, I believe in the market. I believe in the long term, and I don't want to miss the opportunity.
And I also
there's
think
not a lot of you, but there are some.
But I also think you have to think about really what we noticed with the tariffs is that a lot of the countries came in, right? Germany came in, Vietnam came in, right. Israel came in, a bunch of companies came in, but China did not. And some of our big growth companies, even though they have a lot of cash on hand, right?
Mm-hmm.
They have a very strong exposure to China. Right. And that is something that we are going to look at as we manage the portfolios to kind of, because China's pretty big and strong.
125% tariff is 125% tariff.
Yeah.
I mean, that's.
And they may not want to negotiate with the United States. They may not feel they need to.
We'll see. I mean, we had company, I forget who today, one big tech company today said they're going to move everything out of China to India.
Right.
I mean, that'll take time. That can't happen overnight.
Right, but that may mean a reduced exposure to companies that, and we have some great research on that actually, on what companies depend on China more.
Mm-hmm.
And you may see us reduce some of that position because that is an area where we think it's going to be an issue. But the most important thing that we want to make sure that people understand, because honestly, I'm very proud of our clients. I have to say that.
You guys were awesome this week.
I think as those of you who are on the call, and I don't know if the ones who Tammy had to talk off the ledge, but there were only 3 talking off the ledge. That was impressive.
I only had 1.
Okay, so 4 people to talk off the ledge. That's really good. But at the same time, I do think it's important to really think about, okay, I don't want you to think, okay, this is done. This volatility is done.
No.
I think this is going to be really
the next 2.5 years.
Yeah, status quo. For this administration has an agenda, and the agenda is to disrupt.
Even when we think there's nothing left to disrupt, I think they're going to find it.
Yeah, and I honestly think there's a lot you can disrupt.
Oh, I agree.
The government doesn't necessarily run so efficiently, so I think there's a lot to disrupt. But I think that it's important so I guess one of the reasons why I wanted to do this was I wanted to talk about maybe some of the options, some of the things that we can look at when the market downturns.
Well, when you have a reduced valuation in your portfolio, and you've been having conversations around Roth conversions, and 3 of you are on the top of my mind, and I think 2 of you registered for this call, so you know who you are. It's not a bad time to execute your Roth conversions at a discounted value, right? So if last week the account was worth $200,000 and this week it's worth $175,000, why wouldn't we try to pay tax on less if we're converting those shares to Roth?
And I think that was what I was just going to say. So one of the things when I did a Roth conversion for a client last week, actually.
Doing it by shares, not by cash.
And I did it by shares.
Yeah,
and
you have to right now.
So it's a little bit more work to do it by shares because we have to get the custodians to kind of move quickly on that, right? But if you're thinking about a Roth conversion, and actually our next webinar is going to be on Roth conversions.
No, we're going to do one in between on cybersecurity because that's what today was supposed to be on cybersecurity.
Well, you're going to do that because I'm going to be on vacation, but I'm going to do the Roth conversion when I get back. So we're going to do Roth conversions because we do think Roth conversions are a really good tool. So we think that's going to be one of our next things. Yep. But Roth conversions are something we can do. We talked about if you have money on the sidelines and the markets go down, what does Warren Buffett say? Because you say it better than me.
Be fearful when others are greedy and greedy when others are fearful. And there's been no truer time to see that than this week.
Yeah.
If you could plug your nose and buy Monday, oh my goodness.
And there were people we did buy for.
Right.
Not the ones that has to go off the ledge though.
No. But it was good. It worked out great.
It really
worked
out well.
And that's been fantastic for the last 3 days. So we'll see. But I do believe that technically it will be hard for the market. Not that we can't revisit those lows because I think we can.
I think we will.
But I think it'll be hard for the market to get too much lower than that. I think we could revisit those lows multiple times, but
yeah,
from a technical perspective, if you look at the valuations companies were getting at, they were cheap. I mean, you were buying Nvidia at $96 a share on
Well,
Monday.
that's what was so annoying to me personally was I was looking at it going, wait a minute, they're back order on their chips. They don't
can't
have enough.
produce fast enough.
You can't have a car without a chip. You can't have a TV without a chip.
Well,
You can't have anything
and you
without a
talk
chip.
about a company with pricing power,
Yeah.
right? People can't buy enough, so they're going to pay whatever they have to pay.
And the other thing is we don't even know how the tariff, because again, the tariff is an add-on, but at the same
Right,
time,
the chips were excluded.
yeah, and the chips were excluded, and that fell on.
Right, and the problem with Nvidia is some of the products that Nvidia, some of the way that chips come into the States, it's already in products.
Right.
And that's where Nvidia would have been impacted. But again, Nvidia's got that pricing power. So to see a company like Nvidia go from $143 a share, I think, or maybe 142 at their high this year to $96 a share.
It was a great sale.
To think that you would recover to 140, and again, that might not be this year. It might be early next year or sometime next year.
It recovered to 112 today.
But exactly, it recovered to 112 today.
Yeah.
So to think like companies like that, to think of companies like Apple, to think companies like Microsoft, in Netflix. Netflix? Why was Netflix impacted?
I have no idea. It was called baby bathwater, kitchen sink,
throwing
and
the
everything.
baby out with the bathwater.
Everything. So the one thing, every other time, and people that know me and Brian, one of us is way more aggressive than the other one of us. Yes. And I'm the more conservative of the two. But this is the one time when the market went down that I wasn't afraid.
She wasn't. First time ever.
And the
We
reason
worked together a long time. First time.
That's because you're old. Sorry. The reason I wasn't afraid was because I had no idea how, and no one has any idea how the tariffs were going to impact. It could make some prices go up, but at the end of the day, we are the consumption economy of the whole world. Everybody needs the United States to spend money, and we are good at it.
Yes,
So at the end of the day, these countries need to sell their goods to the United States.
Mm-hmm.
And unfortunately, in the United States, if you go to buy a TV and you meant to pay $1,000 and you went there and it was $1,200, chances are you're still walking out with a TV.
Yep. All day long.
All day long.
And that's the 20%.
So pretty much it would have been not fun, but it probably would be okay. And I also think the administration expected the negotiation, and if they didn't, they got it anyway, because a lot of countries came in. So I think that the market will act sometimes irrationally, and when it acts irrationally, we should take advantage of it, because if you don't, that's where another slide comes in.
You miss out, right? I mean, so what we've got on this slide, this is in our new partnership with Wealth Enhancement Group. Often you guys are asking us, how's your partnership with Wealth Enhancement Group going? It's really going good. They gave us this slide this week, and they presented this to us this week. And the blue lines going down, and I can't read this, oh my gosh. The blue lines going down are the worst days in the market in the last, I think it's 2 decades, but I can't read it. So the lines to the right of that are the following 1 year, 1 month, 1 year, 3 years, 5 years, and 10 years, what the market has done over those time frames. There's not one of those where it's negative. I take it back. There's one. God, I wish I could
probably
read that.
2008.
Yeah, it's got to be 2008. In 2008, there was an 18-month cycle.
Yes.
Where it was still negative. But after that, look, it bounces up in every scenario. So in every scenario, at least 3 years later, the market is much, much higher. In most scenarios, the year following that bounce, it is not just higher, it's springboard higher.
But the truth is, it wasn't under a administration like this, right? Because a lot of this
True.
is being driven by the administration. This is not typical. But at the same time, if you miss the day like today, if you sold out, if you called us and said, sell, sell, sell. Now I sound like Kramer. Right? Sorry. If you were adamant and said, sell, sell, sell.
If you missed a 2,000 point up day like today, you never have an opportunity to participate in that day ever again.
Yeah.
It's gone. You missed it.
So that is back to me making the point of, let's look at what you have in equities. Let's look at what you have in bonds. Let's look at what you have in cash, because you cannot control the market, but you can control
your allocation.
Your allocation, which controls how much of the volatility you feel.
Absolutely. Absolutely. This one tells that story, right? This slide is the impact of being out of the market, right? So the first slide, this is participating in the market from 1979 till March 31st, 2025. Funny how they come up with that date, right? Just last month. So if you never missed a day, $10,000 turned into $1.6 million. And that's participating every day, every high day, every low day, never missing a day.
And that's 100% in equities.
S&P 500. It's just the S&P 500, pure S&P 500. Okay? If you missed just the best 5 days, so 5 days, how many years is that? 70, 80 to 5 days out of 45 years, right? So if you miss just the best 5 days out of those 45 years, your 1.6 goes to, I think that says 1083.
You know you're older than that? Okay, keep going.
Shut up. She's not very nice, but most of you already know that. And that's why you're choosing to work with me more often.
Let's not take
Anyway, so if you miss the best 10 days, so now you're talking about 10 days out of 45 years, you are down to, let's say 578. I know you can't see it either.
Enough.
578,000. If you missed just the best 50 days out of 40 years, you're less than $150,000. I think it says $114,000. And next time I'll get stronger glasses, I promise, for all of you. But you understand the gist. It's missing those good days because there are so few days like today. The last time we had a day that was up over 2,000 points like today was March of COVID on the rebound.
Yeah, I believe that. I was thinking it had to be around COVID.
There were 2,000 points days back to back in COVID, and it worked like a springboard. And
this is why, honestly, a young person really needs to stay invested. But for the retiree, it's a little different, right? Because they're eating from their money.
Right.
So therefore, the asset allocation is correct. As long as it's right,
then we're
not drawing on the equity portion.
Exactly. You don't have to sell the equities when they're down.
Exactly. So
to create your income.
We're allowing the equities to run. And even though the statements look bad, and I declared Thursday or Friday when a couple of clients called and said, what do you think? I said, didn't I tell you it was a holiday? It's called no statement looking month. We don't look at them when they're bad because we don't want to react. So sometimes you just have to
plug your nose
and
close your eyes, have a glass of wine, whatever it takes.
Stay status quo or buy
right.
Because it's an opportunity. And we're going to, for those of people that have some
mix
liquidity, we will be making those. I made a couple little changes last week, and we'll continue to do that.
Mm-hmm.
But for those of you who I think really probably should look at your balance of equity to, that's one of the things we talk about on the review is you're currently 70% equities, 30% cash and bond.
Mm-hmm.
And I have a lot of people who have said to us prior to this time, why do I have so much cash and bond? And I would be like, well, 2 reasons. 1, because you don't like the full volatility of the market. And number 2, you need opportunity, time for opportunity.
Well, 3 then.
And 3, income, right? So these are all things we want our clients to really think about and call in for your reviews.
Right.
And call in so we can talk about this, so we can adjust, because honestly, we're not mind readers.
Right.
And
I was just going to say, if you are concerned, if you are losing sleep at night and we haven't heard from you, call us. We are here. We're not hiding. We're not running away. We're here to help you make good, solid decisions about your money. Because at the end of the day, it's your money. You have to be able to sleep at night. You have to be able to believe in the portfolio that you have. And we work hard to make sure that those portfolios match up with your risk profile, but we're not always right.
But the truth is, in the past couple of years, the markets have grown dramatically.
Mm-hmm.
And, you have to admit that as
equities have overgrown, maybe.
Equities have definitely overgrown. And then when the markets were good, so people were like, yeah, keep it that way. It's good. I know I'm 80% in or 85% in, because they weren't.
Comfort makes you comfortable.
Right. They weren't worried about it. But we don't think that's going to continue under this administration. Right. We think we're going to get volatility. That doesn't mean we think the volatility is going to be a net loss. We don't think that.
Agreed. I was just going to say the same thing. Volatility in a positive market they can go hand in hand, and we believe that they will go hand in hand
Yes.
in the coming year and years. So while yes, we see the roller coaster in big swings, we think that it's just going to go this way. It's not going to go this way. We don't believe it's going to just go straight down.
I mean,
We
things can
still
happen, but we
believe
don't think right now.
that the roller coaster will still finish the year higher than it started the year. And it's just, when do you participate in the roller coaster, and how much of that roller coaster do you feel? I spoke with another client today, a very conservative client, who couldn't be more happy that her exposure was muted during this volatility. You actually walked in while I was on the call.
Yes, I know who it was.
And she couldn't have been happier. I said, you're down 3% during this volatility. And she was thrilled. And I also explained, last year, you made very low double digits when the market did 20-something%. And she was okay with that because she said, Brian, I'm conservative.
But you know what? That actually brings another point to me, is that sometimes it's really funny to me that we measure year to year, right? When I look at a client, I look at where they started the year, where they end the year, where they started the year, where they end the year.
Oh, I know where you're going.
Clients like to look at the top, the best day ever to.
I lost.
Yeah. So we have to look at it. We have to pick times, right? We can never pick, because I can't pick the worst day ever and say from the worst day ever, you're up this much. I have to say basically from January 1 to December 31st, that's where you are. And when I looked at that, because we were following, I want you to know, when markets move, we follow
daily
our performance daily. We want to make sure we're there. And even with the people that were very exposed to the market, they were not losing in some areas. In the growth, that was pretty strong.
Yeah, growth was strong.
But in dividends and so forth, the S&P was at one point down, I think, almost 14%. And we were not even close to that on the dividend portfolio. So these are all things we're looking at, and we're here to change things if we need to. But I really wanted to do this little conversation to make sure that we're telling you to look at your allocations, look at your exposure. The market gave us back 2,000 points. Fantastic.
And it rallied into the close.
It rallied into the close. We may even have a good day.
May have a good day tomorrow, folks.
That would be nice. So look at it. And if you're uncomfortable with what just happened, reach out to us. Let's do a review. Let's talk about it. Let's adjust.
Right.
Because
come up with a plan.
We have more of this coming up.
For sure. But most importantly, we appreciate you all. And thank you all for coming and joining our call tonight. We are recording it, so if you want to see it again or if you want to share it, we'll make that available.
Go Positive Market.
And call us if you need us, seriously.
Yeah, definitely give us a call.
Note, do not hesitate to call the office if you need something.
All right.
We're here.
Talk to you guys soon.
All right, bye.
Bye-bye.